Well, JP Morgan has come out on a note on the entire insurance sector. Well, they mentioned that they expect stable persistency and normalizing value for new business from life insurance companies in second quarter, which would further see a good recovery moving into second half of FY21 also. While they also caution that VNB could be slightly low quality while ULIPs will continue to remain out of flavor. However, the rate of decline in the linked products would also taper or decline going forward. While talking about the non-life insurance players, that's a general insurance segment, lower motor and health claims should drive an improved combined ratio, but at the same time they also remain wary of an escalation in the claims ratio in the second half of this fiscal. They add that insurers within this general insurance space, they expect ICICI Lombard's combined ratio to improve to 99.4%, while for PSUs like New India Insurance should see sharper improvement of a high base and with an improving product mix. Well, the industry premiums for the general insurance are trending at 10% growth YOY with a favorable motor outlook in the second half, while at the same time health and fire growth to sustain at the current levels also. Well, they mentioned that insurance have underperformed in the last 3 months after a brief initial outperformance post-COVID-19, which somewhere now signals that there are expectations of slow recovery. Well, they also add that multiples are at mean levels and they see a case for better risk reward in the event of a correction in life names. Now, talking about particularly the players within the life insurance space, they mentioned that ICICI Prudential is at 2 times FY22 price to enterprise value and happens to be their top pick. While at the same time, they continue to be overweight on SBI Life, while at the same time awaiting some amount of clarity on the banca channel growth in order to rate it as their top pick. They also add that a stable order book, a stable back book, a limited risk to operating variance, and also value of new business accretion should drive close about 11 to 16% YOY growth in enterprise value in the first half of FY21 itself. Macro also largely is stable for both P&L and balance sheet. Well, they particularly mentioned that equity market rally and stable bond yield largely remain positive to neutral for P&L and solvency capital, which pretty much remains adequate for all the players within the insurance space. On life insurers non-par book, they do not expect any additional reversing or charge yet, reflecting the interest rate decline since last year given the consecutive discount rate assumptions and adequate hedging. So in an overall, the fund house remains a little positive on the overall outlook for the insurance space. They believe that going forward there would be better risk reward returns for the entire sector, and within the players they believe that life insurance players and within life insurance ICICI Prudential and SBI Life happen to be their top picks. In fact, however, they are awaiting some amount of clarity on the banca channel growth for SBI Life, but nevertheless they remain a little optimistic and positive as far as the insurance space is concerned.